This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, July 14, 2026, and this is the New York session. Now, let's get into it. We are watching a profound dissonance unfold in the crypto sector. Total market capitalization is up 4.16% to $2.309 trillion, yet the fear and greed index is anchored at a crushing 14 out of 100. This is extreme fear coinciding with a broad-based rally. How do we reconcile a market that is statistically terrified while simultaneously rallying on four distinct fronts? Let's dissect the data. Turning to our schedule, the primary event on the horizon is the monthly options expiration landing on Wednesday, July 17, 2026. This quarterly rollover historically dictates the volatility envelope for the subsequent week, influencing how institutions position their delta-neutral books. Apex, given the current low VIX environment, what is the structural implication for that expiration?
The structure suggests a compression squeeze, with the VIX at 15.3, implying traditional markets are pricing in zero turbulence. The options expiry acts less as a directional driver and more as a volatility suppressor. We are likely looking at a contained range bound by the current spot prices until new liquidity enters the system post-expiry.
So we are sitting at a pivot point where sentiment is broken, but price is advancing. Let's walk through the headlines driving this disconnect. First, Cointelegraph reports that Iranian crypto outflows have spiked 700% following U.S.-Israeli airstrikes. Second, CoinDesk notes that the U.S. Senate housing bill includes a CBDC ban. Third, Cointelegraph highlights that Bitcoin futures demand has fallen to 2024 lows, raising questions about institutional presence. Let's start with the geopolitical flow. SPECTER, a 700% spike in outflows, usually signals panic selling. Is that pressure visible in the order books?
It is visible, but it is being absorbed. The 700% spike in Iranian outflows represents a localized liquidity drain, yet the broader market cap growth of 4.16% indicates that this sell-side pressure is not overwhelming the bid wall. The market is digesting this shock without a corresponding drop in price, which actually reinforces the resilience of the current spot levels. However, we must remember that this is a regional distortion, not a systemic collapse.
Absorbed but present. Now, let's look at the regulatory landscape. The Senate housing bill includes a CBDC ban. Pulse, does this legislative development shift the sentiment metric, or is it priced in? It is a foundational pillar for the current sentiment, not a new catalyst. The 14 out of 100 fear and greed score reflects a deep-seated distrust of centralized control, which the CBDC ban explicitly codifies. This narrative is anchoring the retail refusal to sell, creating the paralysis we see in the data. Traders are holding onto digital assets precisely because the alternative, a state-controlled currency, is being legislatively blocked. This isn't changing the daily mood. It is sustaining the floor. And finally, the institutional void. Cointelegraph reports Bitcoin futures demand is falling to 2024 lows. SPECTER, you flagged this earlier. Does this lack of leverage explain the gap between the price action and the fear index?
Exactly. This is the core contradiction. The price is rising at $64,829, up 4.82%, but there is no leveraged long exposure backing it. When futures demand drops to 2024 lows, it means institutions are not committing capital to this move. They are waiting. This leaves the rally entirely dependent on spot buyers and retail enthusiasm, which explains why the fear and greed index remains so low. We know the smart money isn't here yet. It makes the structure fragile. If spot buying slows, there are no institutional bids to catch the falling knife.
A rally built on spot strength but devoid of institutional leverage. That is a risky foundation. Let's drill down into the assets themselves, starting with the market leader, Bitcoin. It is trading at $64,829, up 4.82%. Grid, how do you read the technical structure of this move given the low futures volume?
Technically, Bitcoin is holding a rigid support framework. The price is consolidating above the $64,000 threshold, which is acting as a hard floor. The 4.82% gain is not a breakout. It is a reclamation of lost ground. The volume profile suggests distribution rather than accumulation. We are seeing smaller candles with lower wicks, indicating that every dip is bought immediately by spot market participants. But there is no aggressive bidding at the upper end near $64,938. It is a defensive hold, not an offensive push.
Defensive hold. CIPHER, does the flow data confirm this defensive posture? Or are we seeing large wallet movements that suggest otherwise?
The flow data aligns with grid assessment of caution. We are not seeing the massive exchange inflows typically associated with a distribution phase by long-term holders. Instead, we are observing a stabilization of stablecoin supply on-chain. The capital is not rushing in to chase the $64,829 price. It is sitting in reserve accounts, waiting for the monthly options expiry on July 17th to clear. The flows are static. This supports the idea that the current price action is an equilibrium test, not a trend initiation.
Static flows defending $64,000. So Bitcoin is holding the line but not attacking. Let's move to the clear leader of this session, Ethereum. Ethereum is up 7.15%, trading at $1,881.48. Apex, this outperformance is significant. What does the ratio structure tell us here?
The Ethereum/Bitcoin ratio is the primary indicator of health in this rotation. Ethereum's 7.15% gain versus Bitcoin's 4.82% gain indicates a definitive shift in risk appetite. Capital is moving out of the lowest beta store of value and into high beta utility. This is confirmed by the total 24-hour volume of $74.83 billion. The liquidity is not trapped in Bitcoin. It is circulating into Ethereum. This is not a dead cat bounce, it is a sector rotation.
Sector rotation. Grid, does the chart at $1,881.48 reflect a valid breakout, or is this a false signal given the broader market fear?
This is a valid technical breakout confirmation. Ethereum has challenged and held the $1,900 resistance zone, effectively shifting the psychological barrier from $1,800 to $1,900. The candle structure at $1,881.48 shows strong closing strength, rejecting lower timeframes. More importantly, the relative strength line against Bitcoin is trending upwards. In technical terms, when one asset breaks resistance while the other consolidates, you have a confirmed leadership change. The setup is clean. There are no overhead supply zones until higher levels, giving the bulls room to breathe.
Clean setup. Pulse, how is the community reacting to this Ethereum leadership? Is the sentiment catching up to the price? Not yet, and that is the opportunity. The fear and greed index is still at 14 out of 100. Retail traders are hesitant to engage with Ethereum because the overall market narrative is still dominated by fear. However, the social buzz around utility tokens is heating up. People are discussing the plus 7.15% move, but they are doing so cautiously. This disconnect, where price is leading and sentiment is lagging, is the sweet spot. It means there is still room for fear of missing out to kick in as the trend persists. The sentiment hasn't flipped to greed, but the apathy is breaking. Apathy breaking? SPECTER, you've been quiet on Ethereum. Is there a risk here that this leadership change is premature?
The risk is that this leadership change is a liquidity trap. If Bitcoin fails to hold $64,829 and breaks below $64,000, Ethereum's relative strength becomes irrelevant. Altcoins tend to underperform during broader corrections. Since we know from the headlines that Bitcoin futures demand is at 2024 lows, if the macro environment shifts, Ethereum will likely face steeper percentage losses than Bitcoin. We are witnessing a flight to quality within the crypto space, but it is still within the same sinking ship unless Bitcoin stabilizes definitively.
A valid caution. If Bitcoin slips, Ethereum follows. Let's look at the high beta movers, specifically Solana. Solana is up 4.31%, trading at $77.62. CIPHER, where is the flow coming from for Solana?
The flow is algorithmic and velocity-driven. Solana is capturing volume from decentralized exchange activity and meme coin speculation, which is currently dominating the on-chain ledger. The $77.62 price point is supported by consistent block utilization rates. Unlike Bitcoin, which relies on institutional custody flows, Solana's liquidity is generated by high-frequency trader activity. The inflows are real-time and reactive. This makes the volume robust, but also transient. Once the speculation cycle cools, these flows can reverse quickly.
Transient flows. Grid, is $77.62 a sustainable level, or is there resistance looming?
At $77.62, Solana is approaching a confluence of moving average resistances. The 4.31% gain has pushed it into a zone where previous consolidation occurred. The key level to watch is the $78 area. If Solana can maintain volume above $77, it will likely grind toward that resistance. However, the current candle formation suggests indecision. We need to see a decisive break above $78 to confirm further upside. Until then, this is a range-bound ascent.
Range-bound ascent. Now, let's look at the news-driven outlier, XRP. XRP is up 4.94%, trading at $1.11. The headline from CoinDesk mentions PayPay, 40% owner of Binance Japan, seeking up to $1.1 billion in a Nasdaq IPO. Apex, how does this corporate catalyst integrate into your synthesis?
This is a classic narrative-driven liquidity injection. The PayPay IPO filing provides a tangible reason for capital to enter XRP, separating it from the broader market beta. In my synthesis, this creates a decoupled vector. While Ethereum and Solana are riding the tech rotation, XRP is riding the financial institutionalization narrative. The $1.1 billion figure suggests substantial capital deployment, which anchors the $1.11 price. It transforms XRP from a speculative asset into a proxy for traditional finance entry into crypto. This reduces its correlation to Bitcoin in the short term, making it a hedge against the Bitcoin futures weakness we discussed earlier.
A proxy for TradFi entry. Pulse, is the sentiment around XRP different from the general market fear? Yes, distinctly. While the broader market is at 14 out of 100 fear, the XRP community is experiencing a surge in engagement metrics. The PayPay IPO announcement has activated dormant holders. The sentiment is not greedy in the manic sense, but it is confident. There is a belief that this IPO filing provides regulatory clarity that other assets lack. This confidence is insulating XRP slightly from the broader 4.16% cap gain dynamics. It is having its own microcycle. Microcycle confidence. SPECTER, what is the danger here? Is the IPO news already priced in?
That is the precise danger. A 4.94% move on a specific headline often indicates front-running. By the time the full scope of the $1.1 billion raise is understood, the easy money will have been made. If the IPO filing encounters delays or regulatory hurdles, the $1.11 level could become a ceiling rather than a floor. The risk is a sell the news event, where early buyers exit into the liquidity provided by retail investors, chasing the headline. We must monitor if XRP holds above $1.1 without the headline pushing it higher. If it stalls, the sentiment flip could reverse rapidly.
A potential sell the news trap. Let's look at one more mover, Cardano. Cardano is up 5.37%, trading at $0.1646. Grid, why is Cardano moving now?
Cardano is exhibiting a late-breaking technical setup. It has been lagging behind Ethereum and Solana, but the 5.37% gain suggests a catch-up phase. Technically, Cardano is breaking out of a prolonged horizontal consolidation zone. The $0.1646 level is breaking above local resistance. In a rotation scenario, capital moves from Bitcoin to Ethereum to Solana, and finally to lower-cap smart contract platforms like Cardano. This move is consistent with the final leg of an altcoin rotation cycle. The volume support is weaker than Solana, but the price action is valid.
Final leg of rotation. CIPHER, is there on-chain evidence of this late rotation?
There is, we are seeing increased developer activity and deployment counts on Cardano networks, which often precedes price appreciation in this specific coin. The flow data shows small to medium wallet accumulation, suggesting that individual investors, not large funds, are driving this 5.37% move. It is a grassroots accumulation pattern, which can be slower to develop, but potentially more durable than the velocity-driven flows we saw in Solana.
Grassroots accumulation. Finally, let's address the broader risk flag mentioned in the briefing: Core Scientific turning lower after disappointing Q4 results. SPECTER, does this mining stock weakness pose a systemic risk to the crypto assets we've just analyzed?
No, it is sector-specific noise. Core Scientific's disappointment impacts proof-of-work miners and their direct proxies. However, the assets we are discussing, Ethereum, Solana, XRP, are largely proof-of-stake or utility-focused. Their valuation models are disconnected from energy-intensive mining profitability. Therefore, this headline is a distraction. It does not threaten the structural integrity of the altcoin rally. It simply indicates that the mining sector is undergoing its own deleveraging, which is unrelated to the token price action of the major caps.
Understood. Mining weakness is isolated. Let's bring it home. Apex synthesize the day. We have Ethereum leading with $1,881.48, Solana holding $77.62, and Bitcoin defending $64,829 amidst extreme fear. What is the actionable reality?
The reality is a strategic divergence. Grid highlighted the clean breakout in Ethereum and the late breaker status of Cardano, which aligns with CIPHER observation of stablecoin reserves waiting for the July 17th expiry. SPECTER correctly warned that this entire structure rests on Bitcoin holding $64,000, as the lack of futures demand means there is no cushion for a breakdown. My synthesis is that the risk-reward favors the utility layer, specifically Ethereum and Solana, because they have demonstrated actual volume and developer interest, unlike Bitcoin, which is merely defending support. The PayPay IPO gives XRP a unique narrative shield, but it carries the sell the news risk SPECTER identified. The market is rewarding utility and punishing hesitation.
Rewarding utility, punishing hesitation. Key takeaways from this session. First, the market is exhibiting a severe sentiment price divergence, with fear and greed at 14 out of 100 despite a 4.16% cap gain. Second, Ethereum has taken clear leadership over Bitcoin, with a technical breakout confirmed at $1,881.48. Third, while spot buying is strong, the collapse in Bitcoin futures demand to 2024 lows suggests this rally is fragile without a resurgence of institutional leverage. Tomorrow, watch for Bitcoin's reaction to the $64,000 support level and any updates on the PayPay IPO filings. This is ShadowQuant Crypto Edition. Stay analytical. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.